Hey, everybody. This is a tricky one today, but it's one I always get questioned time and time again. And people always ask for more clarifications. And I normally do these once a year or so to recap on where we are, look at what's happening with debt and inflation and CPI and debasement and all that stuff. But this time I've got a new twist, which is a little bit alarming, but good news towards the end of the video because I do show you how you can escape this whole problem. And this goes back to the magical 14%. As you know, if you watch this channel, Rusted Woods, thank you so much. I've been talking about 14% for years. It's so critical that you have to make at least 14% per year, or else you're not treading water. So let's get into the story. Again, I warn you, it's tricky, but it's also fun. And I have a new way of explaining it too. So the story is what happens if you don't make 14%. Thank you as well to the mods, Sean Donnelly, Team Details like K8, everybody else for being here. And shout out to Lord Godiva from Patreon. I am a member of Patreon. A massive thank you for how my life is now. I own Bitcoin, Sol, Tesla, and MSTR, I say. I've retired on the strength of those investments as I don't have a pension. Great community to be in, and I'm truly grateful. Well, I'm very grateful to have you as well. And thank you to the team behind me. And yes, this is a Bitcoin story. For those of you who may think it's just a macro story, no, it's about Bitcoin and other assets and other changes that could save the day for us all. Now, shout out to Carl as well. The inspiration for this, a lot of people like Gase in the community out of France. We have a French member who's very interested in this question, as well as many others across Europe and the US and Canada and New Zealand and Australia and Germany, etc. Linda, thank you so much. This is what Carl said. Alert, the US dollar devalued by more than 363% since 2000. That's 14.5% devaluation per year. Notice a pattern here. You're going to hear the number 14% many times today from different angles, which is fascinating. And that means if your savings don't grow, your assets, your wealth, etc., your income don't grow by 14.5% annually, you're falling behind. And per Carl, Bitcoin fixes this. The chart is from River, and it shows you the monetary inflation. The true extent of the US dollar devaluation since 2000 is 363%, and consumer price inflation is 88% since 2000. I'm going to kind of dig into both because it does get a little bit tricky, and it's good to see so many kind of macro people here. Myron, thank you so much. And by the way, this is the type of stuff that they should really be teaching in school, but they don't, or universities, but you can learn it here. So let's break this down. Now, a week or two ago, I talked about killer CAGRs and how important compound annual growth rates are. But here, breaking down 2000 to 2025 per Carl's tweet, the money supply increased by 363%. That sounds alarming, but the CAGR of it is just 6.4%. Remember the miracle of compounding? That means it goes to a very large number very quick over 25 years. And the CPI, 88% over the same time period, but that's much lower. The big thing we want to get at here is much lower than the money supply increase. And they should normally match. But the question is the CPI measured incorrectly? Does it really reflect the truth? That's going to be the first thing we dig into today. So first of all, we'll dig into why the CPI does not track or do a very good job of tracking actual inflation. And the reason is a number of reasons, and it gets a little bit tricky, but I'm going to take a second to break them all down. First of all, it doesn't exactly track money printing because it's much lower, because real GDP growth absorbs some of the money by increasing the supply of goods and services. Also, with C19, particularly over the last 5 years, there was a reduction in the velocity of money, it dropped by about 40%, which means new money circulating more slowly, reducing its impact on prices. The more people are trading apples, the more the price of apples go up, and vice versa. Also, asset inflation. A lot of money went into hard assets. If you watch this channel, I urge you every day to get into hard assets. Those being things like Bitcoin, real estate, stocks, etc. Also, productivity. Some things have gotten cheaper because there's more manufacturing sophistication, more automation. Things like flat screen TVs, but you can't eat them, by the way. EVs, TVs and EVs, that rhymes. EVs have gotten cheaper. The electric vehicle parity now is less than an ICE vehicle. The average price of an ICE vehicle in the United States today is $49,000. And the average price of an EV is less than that. And they're much better. And they cost you a lot less money, no maintenance, no gas, etc. Anyway, that's one thing. The other thing is economic slack. There can be weak demand, which kept things a bit limited. But probably the biggest issue for CPI and why it's so dodgy is the fact that it doesn't capture the true extent of actual price increases because they cherry pick stuff and they measure stuff in a very archaic way, like annual surveys for rent and silly stuff like that. Anyway, and they exclude things that I love and enjoy very much, like coffee. Why? Well, let's look at some CPI numbers over the last 5 years, just to give you an example. Now, this one here includes eggs. Eggs went up a lot. I won't get into the reasons why, but there's a crazy reason why. But we'll exclude eggs. And there's a funny meme here. I never thought it'd be cheaper to paint avocado pits for Easter, but here we are because eggs are so expensive. But that's being fixed right now as we speak. The price of eggs has fallen a huge amount over the last couple of weeks. But anyway, this is the CPI increase I want to focus on, excluding eggs. Actually, this one, let me see. Let's go back to this one. The average CPI increase since 2020 is 56.61%. If you pull out eggs, it's 37%. And that includes things like auto insurance, 55.4%, homes, 52.3%, gas, 43.3%, oil, 42%, transport, 36%, used cars, 35%. Electricity, 33%, unless you're in California, then there's a lot more than that. It basically tripled. Takeout, 30%, etc. You see, it's all there. Everything has gone up a lot since 2020. And that's caused a lot of pain out there. Now, another view of why all of this is happening and why there's so much money printing, we'll get back to kind of inflation in a second. But here you can see debt will increase by $5.2 billion a day, every day for the next decade, which is crazy. Also, 1 year ago when I did this video, well, something similar to this, the debt was $33 trillion. And the key thing you need to see here is the debt per citizen was at 98,000. The debt per taxpayer, even more important, was 255K. Remember, a lot of people don't pay taxes. A lot more than half the population do not pay taxes. And the top 5% pay half of all the taxes. So bear that in mind. But look at this. Debt per taxpayer today, 1 year later, has gone from, what I have, 255,000 to 323,000. That is insane, the amount of debt. We'll get more into why debt happens, and it's going to get even more higher because of the deficits. They got to print even more money, which will debase things even more, which means there'll be more and more inflation, which you may or may not see. But I'm going to show you a new way of viewing actual erosion of your purchasing power, which is quite alarming. By the way, I want to add this. They added Doge to the debt clock. Doge has saved each taxpayer $2,186. But when debt per taxpayer is $323,000, you'll see it's a spit in the bucket. But it's $250 billion in a couple of weeks. Not bad, but not enough to stop the problem. The problem needs to be solved in another way, which we'll get to in a second. Also, another 14%. You cannot make this up. U.S. unfunded debt is up 14.79% just in 1 year. 1 year ago it was 169 trillion. Now it's 194 trillion. This thing is exploding. Where is this money going to come from? It's going to be printed and it's going to debase you hard. All right, but there is a solution. This is, let me turn off the little me so you can see the whole slide. This is looking at debasement from another angle. This is super interesting. This is the income required to buy an average home in the United States. And you can take this data wherever you are on the planet. If you are in the Netherlands or in your Auckland, New Zealand, or Sydney, Australia, and there's even more extreme in those places because real estate has gone completely bonkers. And the question is, has your salary, your wage kept up with that? I don't think so. So if you take things like your 14%, and this is where it gets really tricky. This is probably the trickiest part of this little presentation today. So bear with me here. I'm going to try and explain it. 14% annual debasement after 5 years. You'd only retain about 47% of your original money. So in terms of purchasing power, it may not appear this way, but $100 in 2020 will be worth about $47 in 2025. Now, when we adjust the 2020 house price, okay, the income needed to buy a house. So here, it was 51,000 in January 2020. And for this extreme debasement, you'd think it would only be worth about 24,000 in 2025 in purchasing power. But the actual house price, the income you need to buy the house price today is 92,000. So if you debase the cash income, okay, from 2020, and you forecast it forward to the actual income needed today to buy a house, real estate gained about 3.81 times its inflation adjusted value, nearly 4x. And this represents a 280.9% real gain after accounting for currency debasement. What this basically means is real estate is a very, very good hedge against inflation. And it happens quietly. You don't really see it, but it delivers returns that outpaced the loss of purchasing power of a currency. Now, it's really tricky to wrap your head around this, so I hope people kind of followed that. But I'm going to explain it with a few things. The question is your income keeping pace with the new cost to buy a home, average home in the United States? So if you are earning $51,000, called it 50 grand, in January 2020, are you earning 93,000 today? Because you need to be able to buy the same level of house. But we've seen what happens to not only, well, we'll get into if your income's keeping up, but we'll get into when we discussed it around the price increases that have eroded your income. But this is a 79% shift in just 5 years of how much more you need to earn. And trust me, if you are working for a corporation, you'll be lucky to get 2.5% per year, unless you're a star employee. And that is not keeping up. Now, these are the housing prices. I'm going to turn this off again. Housing price increase. Okay, from TradingView. You can look it up yourself. U.S. Average housing price, American single family home since 2000 is up 189%. That's 25 years. But basically, what that means, the average house back then was $140K. Now it's $400,000. So up, call it 200%, which means it's tripled. The other thing that's important to know when you look at this statistic is the key point to remember. There are markets, real estate markets in the United States that have actually gone down over the last 25 years. You take big cities that have had a fall in population or an economic rout or other things or huge excessive building, keeping prices down, they've gone nowhere. This is average for every single house in the United States. Some markets have been completely on fire. Some have been horrible. And we saw huge fluctuations just over the last 5 years. So that's the first part of homes. The other thing is the housing price increase of how much it's gone up in the United States. And again, this is reflected all over the world. And occur again, if you're in, say, Frankfurt or Copenhagen or Sydney or Toronto, wherever else, Vancouver, Sao Paulo, it's crazy. Take Portugal as well, huge increases in prices. This is the housing price increase since 2020, up 49.61%, up 50% just in 5 years. But it gets worse. This is the Case-Shiller home price. It has a slightly different number. Since March 2020, it's up 50.4%. 50.44% is a very large gain. And again, you got to think back to the CAGRs. So the year over year CAGR between 2024 and 2025 is just 4.1%. But since March 2020, some of the years were extremely high, month to month. These are month to month gains. And you saw back in 2022, you could have a 2.7% increase per month. The following month, a 2.6% increase. And that compounding effect is huge. That means that's why just in 5 years, real estate went up by over 50%. The question is, did your salary go up by that much? As the first part. Now, another proof point. We'll get back to all of this and how to escape it. This is another thing I shared in a previous video a while back. Back in 1971, it took 25 hours of labor to buy one share in the S&P 500. Today, it takes 195 hours of labor. Okay? So basically, the total value of our corporations or stocks in the S&P 500 has grown 650% faster than our wages. The point here is everything's going up faster than our wages. And the cash that we have is also being debased. So you got to take these two things eating at your wealth at the same time. And that's the point I'm trying to make today. But let's get back to the slides because a lot more to talk about. That is kind of stunning. This is why I urge you, own hard assets, own stocks, own real estate, own Bitcoin, own disruption. These are critical. Now, this is also interesting. The S&P grows 75 times while wages fell 90%. This is why I hate to use the term, but a lot of people refer to it as wage slavery. It's very difficult to escape the matrix when you have a setup like this. Okay, since 1971, the economy grew by 28 trillion at 24x. That's crazy. The S&P 500 grew by 75x, and your average wages in real purchasing power versus GDP have fallen by 90% in just a little over 50 years, which is crazy. And then there's this. Okay, you've heard me talk about this before. This is since 1970. GDP, gross domestic product of the United States, has gone up 24 times. But debt has gone up 97 times. So what does this mean? The economy has grown 24 times. Debt has grown 97 times, which basically means for every dollar the government spends, it creates a dollar. Would you invest in the government? The answer is no. They are the worst capital allocators in the world because of all the waste, fraud, and abuse, and grift, and inefficiency, and archaic systems, and crazy things like that. So again, we've discovered the erosion of purchasing power with inflation and debasement. We've looked at real estate, on how salaries are not keeping up with real estate. It takes nearly double the salary in just 5 years to afford the same home in the United States. Same country, same home, double the salary in 5 years. Okay? You're getting a lot less house for your wages today, unless, of course, your wages have doubled in 5 years, which I doubt they have. But there's more. That's the capital allocation part. This one, Saifedean, yet another 14%. And I shared this years ago, and I love this. I read his book, but basically, he came to the same conclusion. Average global fiat experiences 14% dilution every year. Now, global money supply, call it 100 trillion, global wealth, 400 trillion. And every year, humanity loses 14 trillion, 3.5% of global wealth, because of money printing and financing and debasement and erosion and purchasing power. It's all built on a house of cards. And the money, a lot of the money is spent by governments who waste it. Again, I'll repeat, for every $4 they spend, they create $1. I send you out to the shops, get me a loaf of bread. You buy 4, but you lose 3 of them on the way home. That's the way you need to think about it. I just came up with a very crude analogy, but I hope it makes sense. So that's this part. Again, 14%. Back to Carl at the very beginning, 14%. Back to the actual, what was the other 14% I had here? Real estate example, 14%. It is happening. Do not trust the government CPI data that you read. Watch the money printer and divide every asset you have by the increase in money supply. Take a stock, take Bitcoin, divide it by M2 to know exactly where you stand. Now, this is the hard truth, okay? Debasement happens, it will continue to happen. And it's way worse when you factor in wage and income growth or lack thereof. If you're fortunate enough to be in a job where you're on commissions and you're crushing it and you're doubling your income every year, you're fine. But you are in the 1% if that's the case. And global debt is unsustainable. We've seen Doge save $250 billion. It's not a spit in the bucket compared to the debt of the government per taxpayer, which they can never escape. We're way beyond the point of no return. Debt will accelerate even faster. And this will all lead to some type of catastrophe, some type of reset that's coming. You're seeing moves made by huge regions like Europe right now because they're nervous about this. They see what's coming. They know what's coming. They've been talking about what's coming for years and years. You'll own nothing and be happy. That's all part of the fourth turning and the Great Reset. It's unsustainable. But the good news is coming. There is a way out. First of all, Bitcoin, as you know, has not had, if you compare market high to market high of 2021 versus today, we're not that much higher. And if you take into account debasement, we're pretty much close to break even. So that tells us the bull market's not over, okay? Because the dollar doesn't go as far, but Bitcoin should be a lot higher if you compare it to previous cycles. Anyway, I'll just park that there. But if you have hard assets, whether it's the stock market or, as I illustrated, real estate is a very good hedge against debasement and your cash being ravaged, you're in good shape. There is a wild card that could save us all, and that is robots. Again, there's a reason, so what am I, 75, 85% in the, crypto and AI, because it's going to be so important for the future. There is a case where something like an Optimus bot from Tesla, which will be showcased in Capitol Hill this week, could accelerate GDP. It's also crucial to consider the impact of job displacements, which is the negative side. But again, I'll give you an example of how this could work. An example of a robot will be a robotaxi. If Tesla can make each one for $15,000 and they let it run on the streets, or they let somebody buy it for $15,000, $20,000, $25,000, and that vehicle generates $50,000 per year, that will create infinite GDP, okay? Invest 15 to get 50, not like the government investing 4 to get 1. It's a complete reversal of what people are used to. That is powerful. That could accelerate GDP, and that could bring about abundant riches. But I do maintain, I believe, the riches will be held by the people that own the assets. Okay? That's why I urge people to own, even if you hate Elon Musk. Get some Tesla, get some AI, get some NVIDIA. Position yourself, because this is coming. And between the AI and the hardness of Bitcoin, you could survive. Maybe even real estate in a very fast-growing city. But there's one other thing too. The other way to escape this matrix is CAGR. If you have a CAGR that exceeds that 14%, you're going to be just fine. And that's what you need to hunt for. And this is from my killer CAGR videos. That's hard to say. By 2032, I do believe some of these assets could do very well. Bitcoin could continue to do a 36.9% CAGR over the next 7 years. MicroStrategy, 44%. Tesla, 55%. Because of that infinite money glitch that they're going to unlock with AI and robots. And Sol, 49.35%. But again, we don't know if any of these things will even exist in the future. So these are the key things to be aware of, everybody. If you're not making 14%, you are drowning, okay? And I'd like to finish with the little meme of the day to cheer everybody up and relax. If you hold Bitcoin, you're going to be in the white pill zone, which means that's okay. We're still going to win. Blue pill is anybody assuming everything is okay. It's not. Therefore, you should not relax if you're in the blue pill zone. If you're in the red pill zone, that things are actually not okay, you kind of know there's a problem, but you're not making the effort to solve the problem. Solve your own problem. Solve your own future. Prepare your own future. That's so important. Orange pill. Bitcoin makes it okay, but do you have enough? That's the question. Black pill. Everything is bad. Everything's going to end. No, you can escape. There's a positive side, and that's the white pill. Okay? Everybody, prepare. Get into the white pill zone, and you will be fine. So, everybody, hope you enjoy the show. Sorry for being a little bit kind of hammering home this point, but it's so important. If you think you're going to make it with the US Treasury making 3.5% per year and then they tax you on that income, you're toast. You're not going to make it. Debasement will accelerate. It's a foregone conclusion. Get things that do better than that debasement to survive. I don't care what it is, but make sure it's hard. Thank you, everybody. I see somebody there did love it, actually. White pill. We got some white back. I look and see these comments. You, Cyclops Gavin, knows it. Do you have enough pills? That's a funny one, too. These are funny. I got to share this. Never enough Bitcoin. That is an old one as well. And let me see. Yeah, and here are the fun comments. Extra black ones. April, seasonally, markets should go bonkers in April. I covered that yesterday in Okta as well. So hope you enjoyed the show, everybody. Thank you, Bitcoin Maxi Max and the whole gang. And remember, I'm sharing US data, but it applies everywhere in the world. In fact, some countries are a lot worse off than the US. US is the least dirty shirt in the laundry. My shirt's clean, but there's probably a cleaner one somewhere. But when it comes to currencies, no, probably not. Anyway, thank you so much. Hope you all enjoy the show. Remember, 14%, make more than that, or else you're going to drown. Take care, everybody. Bye-bye.